What's going on, everybody? Michael Silva here. This indicator suggests that a stock market crash may be happening soon. We're going to talk about that and more, much more, on the Stock Market Brief Show. If you're new here, welcome to the show. My name is Michael Silva. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. I got my blood red pen out today. Oh my gosh, it's so bearish out there. We're going to hop right in today's episode. So the Fed did step in, but we're avoiding the B word, bailout. Right? And you know what's interesting is, whether you think this is a bailout, whether it is or isn't, you would think that with this news, you would see a bigger reaction in the market. And we saw the futures market get very excited, but we closed rather unchanged on the day. This pattern is actually known as a crying Pepe pattern because we actually had a lot of bullishness to start with, but we closed, unchanged. So the bears haven't snapped their fingers yet either. So really, it's just a kangaroo type market. Now, everyone's bullish apparently for tomorrow. So what are my thoughts going into tomorrow? My personal thought is just to ask them what and how they're positioned, because right now we are in the midst of a lot of volatility, and I'm going to prove that to you by showing you the updated expected move. Now, if we take a look at how the market performed today, you can see, there was rather unchanged. A lot of volatility. We had a big hit down in financials once again, and you can see small caps took the blunt of that, really because of, regional banks, right? Small banks, regional banks, you can see took a large hit to the downside today, down another 12.31%. So one, it's safe to say, you get bounces from these overextended levels, and a bounce in regional banks could very well bounce the markets. That is a total probability. But, how much are you willing to put at risk to see about catching that bounce? Because understand that just a swing from this point of 48 down to here on 42, and this is on a spider ETF. Mind you that it's even crazier on individual names, right? If it just comes down from 44 to 42, that's actually a pretty big percentage point drop, okay? Now, this is the indicator that I talked about in yesterday's video, and I said I'm going to bring it back, and I'm going to show you what it looks like when these trigger. So what is it? Okay, so when the summation index, the NYSE, the summation index, crosses down below zero, which it has not yet, it's at 16.70, at around the same time that the NYMOT, the NYSE McClellan oscillator, crosses down below 300, it does signal very poor breath in the markets, and it's led to potential sell-offs. One being right here. That was the pandemic sell-off, given us a heads-up notice. Remember, we actually came down, then we bounced, and then we fell off. The most recent one was the top there of 2022. You can see it all triggered. You might be looking at this one. Well, I was talking about it on that specific day, and guess what? We actually got a 295 reading that day, so it looks like it triggered, but it actually did not. It triggered there shortly thereafter. Okay, and you could see over here, in 2018, we bounced. Boom, we bounced. Everything was fine. But guess what? We actually hit another new low. So there was a lot of volatility there. Then later on in the year, it triggered again where we saw that massive, massive drop there in the markets. Now, I got a question already. Was it the same during the times leading into the dot-com and the great financial crisis? I knew people were going to ask that because, it makes sense. Like, what if we're going to have a big financial crisis? Well, let's take a look here at 2007. Here was the top, just about, right? Well, guess what? The NYSE summation index crossed down below zero at around the same exact time. The NYMOT hit a minus 300 reading, crossing below it, and then we saw that sell side action. We came back up, right? And then we came, obviously, back down, and we went through that financial crisis. So it did give us some heads up notice, but remember, months went by during that time where we did get, we triggered again here. It didn't cross down below the same time. I would consider this one the main trigger. Let's take a look at 2001. This one's very interesting. So we did get a trigger right here as the NYSE McClellan also got down below that minus 300 reading, letting us know that there's something obviously wrong here with the breadth in the market. And you can see this was actually just before a pretty big hit to the downside, and then we saw a big reflexive bounce. But that obviously led to, once again, another low there in the overall markets during that dot-com bust. So this has not triggered fully yet, but it could be giving us the warning signs that, hey, there could be more damage up ahead. Yes, things are oversold. Crashes can happen from oversold conditions. Bounces can happen from oversold conditions. So let's take a look at another element here. The 10-year and 2-year curve, right? A lot of people are talking about this because it's a big move today, mainly driven by the 2-year yield, which I'll point out here momentarily. But if I take a look at the dot-com bust and I take a look at the great financial crisis, we're looking at 2 periods in times where one went down 58%, one down 50%. So what would it look like if the market were to fall 50%? Well, that would take us down to S&P 500, right at around 2,500. If we fell even further to these prior areas of resistance, that would equal to 67% drop, and that's measured from the peak. So peak down to here, okay? Now, what to pay attention to here is the Fed hiking cycle. Now, as I stated, the 10-year and 2-year, right, you can see here, when it's red, it inverts. When it starts coming out of inversion, that's actually kind of when these crashes happen. So it comes out of inversion, crash happens. Now we're starting to see it pop up. Hey, are we going to get back through inversion? And is the market going to fall off? Well, one element to look at here is the the federal funds rate. So this is the federal funds rate down here. And what you can see during this time is while the curve is coming outside back to uninverted, and then it's still there inverted, you can see what was the Fed doing during that time coming out of that period. So as the market was crashing, they actually began taking rates down, right? So right here too, the same thing. Started getting out of inversion, the market started crashing. Guess what? The rate started falling. So is the cycle over? And people are starting to believe that, hey, the Fed rate hike cycle may potentially be over, as the 2-year recently hit that 5% marker, the highest that we've seen since 2007. It fell 12% today. Jim Bianco posted that this today was I'll just read his tweet. Today, the 2-year yield note declined 61 basis points. This is the biggest one-day decline since October 1st, 1982. A lot of things that are taking place now, you can reminisce of the 1980s. The first discount rate cut following the September 1981 all-time peak in yields. To emphasize, today's decline in 2-year was larger than any one day seen during the 2007-2009 financial crisis, following 9/11 and the 1987 stock market crash. Now, he also stated, if markets signal, what is the 2-year telling us? Well, I don't have that answer, but it does not seem all too well. Now, going into tomorrow, right, we are going to be talking about, obviously, the Fed. Are they going to be raising rates still? Are they going to be backing off? There's some banks calling for them to just kind of back off that narrative. There's still a 65% probability that we're going to get another 25 basis point hike. And, I'm kind of leaning on the side that Fed, the Powell is going to still step in and say, no, we're going to get inflation down. But what's really going to kind of alter that view is tomorrow, right? We have core inflation data, inflation rate year over year coming out tomorrow, just a few hours there or an hour before the market opens. So that is what we need to be paying attention to. Now I'm going to talk about specifically how much of an expected move that we got to look out for tomorrow, because trust me, even if we get a monster rip in the markets, nothing from a technical standpoint has actually or will be fixed. So we'll get into that momentarily. SPY weekly time frame, you can see here I added the anchored VWAP from the pandemic bottom just to show you now how price is trading right at around that level. But we were watching this take place here from the anchor VWAP from the high, from the anchor VWAP to the October bottom. You can see price came back up to that level today, right? And then push back aside. So if we really want to see something constructive take place, you want to see S&P 500 back up into this level and get really, honestly, back above, really this high right here, and even potentially the August high. So technically speaking, from a weekly time frame, this looks like not too healthy overall, as it's kind of squeezing outside of those two anchored VWAPs. If you take a look at the daily time frame right here, the year-to-date anchored VWAP is starting to curl itself over. So if we get a move, like I said, right, this bounce could very well potentially get rejected up into that area. So that's going to be one thing to pay attention to if we start getting a rip, so you don't have extreme FOMO. You got to think about these things ahead of time. Now, if we take a look at the 15-minute time frame, the expected move can take us on the SPY up to around 392.68 to down to 378.04. This is over a $7 expected move, which is wild, okay, for one day, right? These are big moves in the market. And we have a lot of things that can even create more volatility. This is basing it off of the CPI report and potentially whatever comes out of the mouth of the Fed or comes out of this banking situation, okay? So once again, you got to continue to be careful. What did we do today? We started with that gap down this morning, even despite people getting excited about futures. So don't get too overly excited about futures. Let the market open up and see what is going to take place. And you can see we anchored a week to date, which is, starts today. It's Monday. It started as a daily. This is a daily VWAP. Now it's going to be week to date. You see price broke through it. It acted as support. We came up. We back tested it. It held as support. And now to close off the trading session, we closed beneath that level. Now it's rather flat. Okay, so it's kind of neutral. But if it starts breaking down and curling, that could be a negative sign for the overall week to date anchored VWAP, and price action moving forward could signal that we're going to go touch that lower weekly expected move. If we get back above it, well, you'd want to start to see this thing start to turn back up. You'd want to start breaking through these highs. That opens the door to obviously that upper daily expected move to potentially even the upper weekly expected move. But there's another thing overhead that we need to be aware of. The 5-day moving average, it's still declining. So if you are and you want to be much more confident from the long side, okay, and if you want to swing trade, because remember, swing trades right now, breakouts, they're busting up back and forth. It's a very dangerous, very volatile environment. So it's really, you got to be somewhat pretty large cash position, small equity position, depending on how you do it, if you are a long-sided trader from a breakout perspective, which is my favorite way of trading. But as it stands right now, you're walking up into, right, a declining, if price moves up, declining 5-period moving average and a declining month-to-date anchored VWAP, okay? So if price were to rip right back up here, you'd still be coming into a declining 5-day moving average and a declining month-to-date anchored VWAP. It could very well hold as a level of resistance. So what you'd want to see if you're bullish is price to get back above this area, right? And the 5-day moving average to start turning back around like so. And then you could buy strength after you see these pullbacks and so forth. And when you see a series of higher highs, but not and higher lows, higher lows and higher highs, instead of seeing stuff like a high, a lower high, a low, and a lower low as such, okay? So that is kind of what I'm looking at going into tomorrow's trading session. Take your foot off the gas, people, because trust me, you don't need to go overly compensated in a volatile market. Typically, when there's more volatility, which I've stated in the past, so if we think of something like the VIX, right? Say if you're used to trading the VIX at 15, okay? Now, and this is just an example. So the VIX is at 15. Now, say it's at 30, right? If you're trading a $100,000 account at 15, okay, that makes sense. Like, okay, you feel fine. But if all of a sudden the VIX comes up to 30, this is doubling the amount of volatility in the markets, so to speak, right? That means your 100,000 is now moving around the market as if it's 200,000, right? This is just an example, but you got to be aware, okay, well, if that's the case, maybe I can lower my sizing and play like potential bigger move down in the markets. We talked about what to potentially look for if the Fed does start lowering rates, and what has caused in the prior crises, right? That we've seen those 58% drop, 50% drop. It could potentially, if we see something similar, could take us to 2,500 in the S&P 500. Be careful, be safe. Yes, things are oversold. I'm not going over all those indicators today. So yeah, it's very possible to see some sort of a bounce in the markets. But if you are trading intraday, understand that volatility right now, it is here and it's not going to subside until we really let some time and things develop. That's all I got for you. See you later.